Okay, let us have another illustrative problem. A 6-column table for Teresa Consulting Company follows. The first 2 columns contains the unadjusted trial balance for the company as of December 31 of the current year, and the last 2 columns contain the adjusted trial balance as of the same date. So we were given the unadjusted trial balance, this one, the first 2 column, and also the last 2 column, which is the adjusted trial balance. The requirement is prepare the journal entries that had been made to arrive at adjusted trial balance and complete the worksheet for Teresa Company as of December 31. Okay. So the first requirement is we have to prepare the adjusting entries. What are the adjusting entries prepared to come up with the adjusted trial balance? Okay. So let us check. So the first account is cash, 56,000. It is still the same, 56,000, which means there's no adjusting entry prepared. For the second one, accounts receivable, we have 40,000. And the adjusted trial balance is 47,500, which means there is an increase of 7,500. So there is an adjusting entry prepared that increases increased it to 7,500. This is an asset, and if we increase, that means there is 7,500 difference for this one. So that is debit. Because from our last illustration, debit equals add, and total post to column 5. So this is 1, 2, 3, 4, 5, and 6. Okay. So what is the adjusting entries that had been prepared, wherein you have entry of debit accounts receivable 7,500? It means this is an entry for accrued income. Because accrued income is an income already earned but not yet billed or not yet received. So, most likely our entry, debit accounts receivable 7,500 and credit revenue. So, we have unearned long-term consulting fees earned of 7,500 credit. So again, the adjusting entry is debit accounts receivable 7,500 and credit consulting fees earned 7,500. So let us write the entry, letter A. Debit accounts receivable and credit consulting fees earned. That is 7,500. Okay. The next one, then we have office supplies, 35,000. It becomes 15,000. So there is an adjusting entry prepared which decreases our office supplies from 35 to 15. So that means there is 20,000 difference. 35,000 minus 15, so we have 20,000 difference. And if we're going to decrease, that is debit and credit. Debit and credit is minus, and the balance, post it to the bigger amount column, 35,000, so this is 20,000 credit. Okay, and this is an adjusting entry for what? For prepaid expenses. Office supplies is an asset, which means asset method were being used, and for our adjusting entry, we're going to record our expense. So, our entry, adjusting entry, that is debit, supplies expense, and credit, office supplies. That is 20,000. So we have here office supplies, salaries, office supplies expense, debit 20,000, and credit office supplies 20,000. Then we have prepaid insurance. It is 7,600 for an adjusted trial balance, and it becomes 5,000. So there is a difference of 2,600. So, 7,600 minus 5,000. So, that is 2,600. Again, it is credit 2,600. Again, prepaid insurance is an asset, which means asset method were being used. So, for our adjusting entry, we're going to record our insurance expense. So, letter C, debit insurance expense and credit prepaid insurance. That is 2,600. So here we have insurance expense. Insurance expense, 2,600. Then we have office equipment, 120. It is still the same 120. It means there's no adjusting entry. Then we have accumulated depreciation, 25,000. It becomes 35,000. It means there is an increase of 10,000. And increase means it is posted on the credit side. Because credit is plus and the total to column 6. Okay. And the entry is to record our depreciation expense, debit depreciation expense, that is 10,000, and credit accumulated depreciation, office equipment, 10,000. So our entry, debit depreciation expense, debit 10,000, and credit accumulated depreciation 10,000. Next is we have accounts payable 32,000. It becomes 40,000. It becomes 40,000. So it means there is an increase of 8,000. So accounts payable credit to increase, it is posted on the credit side. So we have, because credit is plus and the total post to column 6. So this is an accrued expense. It means that we have just recorded an accrued expense of 8,000 because the entry is debit expense and credit liability. So let us look for the appropriate accrued expense or expense for that amounts for 8,000. So we have this one, unearned. This is not an expense. There is no. Okay, Teresa, consulting fees. We have depreciation expense already filled up. Salaries expense, 112 and 127. It is more than 8,000. Interest expense, 7,006, 9,009. It is less than 8,000. This is already filled up. Rent expense, 40. This is still the same. And we have office supplies expense. It is already filled up. But this one, advertising expense from 37,000, it becomes 45,000. So we have 45 minus 37, 8,000. It means that it is advertising expense. So we have here 8,000. So our entry, that is for letter E, advertising expense and credit accounts payable. That is 8,000. Okay, so again, debit advertising expense 8,000 and credit accounts payable 8,000. Then we have 20 salaries payable. Interest payable first. There is no interest payable in our unadjusted trial balance, but there is in the adjusted trial balance. It means there we prepared an adjusting entry for that is for 2,300. Interest payable, it means it is on the credit side because it is liability, 2,350. So that is an accrued expense for interest. So our entry, debit interest expense And credit interest payable. So this one, interest expense of 2,350. So interest expense 2,350. So we have debit A B C D F. Debit interest expense and credit interest payable of 2,350. Okay, next is we have 15,000 salaries payable. So again, this is an adjusting entry for accrued expense, for accrued salaries payable. And that is debit salaries expense 15,000. It means there is a posting of 15,000. That is salaries payable, that is liability. So 15,000. So the entry, the adjusting entry is debit salaries expense of 15,000 and credit salaries payable 15,000. So we have G, salaries expense and credit salaries payable of 15,000. Okay. So 15. Then we have unearned consulting revenue, consulting fees. From 26,000, it becomes 20,000. It decreases by 6,000. This is credit. If we're going to decrease this, it means we have a posting of 6,000 on the debit side. And this one, unearned consulting fees. This is liability. It means liability method were being used. So for our adjusting entry, we're going to record our consulting revenue or consulting fees earned. So our entry, letter H, to record our consulting fees earned, our revenue, it should be on the credit side. So what is our debit? That is debit unearned consulting fees. And credit consulting fees earned of, that is 6,000. Okay, so that is, so we have to post another amount here, 6,000. So unearned 6,000. We have long-term notes. It is still the same. Capital the same. Consulting fees earned. Depreciation expense. Salaries. Okay. So that's all for our adjusting entries. We have 1, 2, 3, 4, 5, 6, 7, 8 adjusting entries. So let us get the total. Okay, so we have 7,500 plus 6,000 plus 10,000, 15,000. We have 2,350. We have 2,600 and 28,000. So that is 71,450. And for our credits, we have 22,600. We have 18,000. We have 2,350, 15,000. We have 6,000, 7,500. That is 71,450. So again, for our trial balance, adjusting entries, and adjusted trial balance, we should have our total debits and total credits should be equal, the same or balance. Now let us continue our working paper or our worksheet. Okay. So this is our worksheet. I have already this one. So I've transferred it already up to adjusted trial balance. So we have here our adjusted trial balance 71,450 and our adjusting entry 71,450. We have 498,000 for our adjusted trial balance. Next is we're going to prepare complete our worksheet by preparing our statement of comprehensive income and statement of financial position. So from our adjusted trial balance, the amount in our adjusted trial balance, we're going to post it again either to statement of comprehensive income or financial position. So for our financial position, it is assets, liabilities, equity, and withdrawal. And for our comprehensive income, it is revenues and expenses. Okay. So for the first account, that is cash. Again, for cash, that is 56,000. It is an asset. So it will be posted in our in our financial position. Next is accounts receivable. Again, it is an asset. So it should be posted on our financial position. Next is, we have office supplies. That is 15,000. Again, it is an asset, so it should be on the financial position. Then we have prepaid insurance. It is an asset, so it should be on financial position from debit, and we're going to post it on the debit side. Then we have office equipment. It is an asset, so from debit to debit of financial position. Next is accumulated depreciation office equipment. It is a contra account of an asset, so it is credit side of our financial position. Next is, we have accounts payable. It is a liability. So, from credit to credit of financial position. Then we have salaries payable. Again, it is a liability. So, it should be posted on a financial position from credit to credit. Next is salaries payable. Salaries payable is a liability, so it should be posted on the credit portion of our financial position. Next is, we have the unearned consulting fees, which means it is also a liability. So it is on the credit side, credit column of financial position. Next, long-term notes payable. Long-term notes payable, it is also a liability. So it is posted on the liability or on the credit side of financial position. Next is, we have Teresa Capital, that is equity. So it is an element of financial position, that is credit, 76,000. Then we have consulting fees earned. Consulting fees earned is a revenue, and that is an element of comprehensive income. So, from credit, you have to post it on the credit column of comprehensive income. Next is depreciation expense. That is an element of comprehensive income. So, it is posted on comprehensive income debit, from debit to debit. Then again, another expense, salaries expense. So from debit to debit of comprehensive income. And again, all of these are all expenses. So we have interest expense, we have insurance expense, we have rent expense, we have office supplies expense, and advertising expense. All of those are expense account, which are elements of financial of comprehensive income. Take note that in our statement of comprehensive income credit column, you only have one posting. The most posting that you're going to have here is 2. That is if we have other income. Example is interest income. So again, take note that for comprehensive income, you only have only one posting. That is for revenue. Revenue account, consulting fees earned. Or the most posting is, you're going to have 2 posting. That is if you have other income, which is, or an example of other income is interest income. Okay. So, again, we're going to get the total of these 4 columns. And the total of these 4 columns is not balanced, because it is unlike the previous column, the 6 previous column, wherein the total debits and total credits are always balanced. But this time, for our comprehensive income and financial position, the total debits and total credits are not the same. So for our total debits of comprehensive income, that is 254,550 and 249,700 for credit side. For our financial position, it is 243,500 and for credit is 248,350. So, getting the difference between the 2 columns, total debits and total credits of comprehensive income and total debits and total credits of financial position, the difference between the 4 columns is 4,850. And another thing is that the credit side is lower than the debit side of our comprehensive income, and the debit side is lower than the credit side of our financial position, which means that is a net loss. So that is why here it is net loss. Take note that in preparing a worksheet or working paper, whatever is, say this one, net loss, so the amount written in this line, 4,850,000, that is net loss. Another example, say this one, unearned consulting fees. All the amounts written in this line refers to unearned consulting fees. So, do not, every amount should be aligned with the particular or specific account title that you are referring to. I mean, again, example, salaries expense. All this amount here in this line refers to salaries expense. Okay? So that is our preparation of worksheet. So let us have our heading again. That is Teresa Consulting Company. So we have Teresa Consulting Company. Worksheet. December 31, 20. Okay. So there ends our topic today. So next time, we're going to have our next topic, that is preparation of financial statement. So what are the steps that we have done already? First is analyzation of the business transaction. Then after that, we have to record the entries in our general journal, or journalization. Then posting to the general ledger or T account. Then after posting, we're going to get the total of its account. And we're going to prepare trial balance. From trial balance, we're going to prepare adjusted trial balance. And in this adjusted trial balance, optional, we can prepare our worksheet. Then after that, we're going to prepare our adjusted, after trial balance, we're going to prepare adjusting entries, And under your adjusting entries, optional, you can prepare worksheet. And after preparation of adjusting entries, we're going to prepare adjusted trial balance. We're done with adjusted trial balance already. So our next step is preparation of financial statement. Okay, see you in my next video.